Welcome back to FT Markets. Life's pretty calm these days in Italy, at least in the bond markets. Volatility has fallen sharply, has also in Spanish bond markets. Indeed, Spanish and Italian bond market volatility is now lower than for US Treasuries. With me to discuss the shift in sources of global instability across the Atlantic is Stefan Dio, who's the head of global asset allocation at UBS. Stefan, the fall in volatility in Spanish and Italian bonds is quite dramatic, and at the same time we have seen a pickup in US Treasury volatility because of all the talk about the Fed scaling back its asset purchases or quantitative easing. Do you think the center of instability is shifting now?
Well, yes and no. You know, this chart is a little bit peculiar. The 2012, you understand.
This is the volatility of returns that you've plotted.
Exactly. You have a very high volatility in Spain and Italy because of the crisis. US Treasury is a safe haven, volatility is low. And then, as you say, with tapering talk, we start increasing the volatility in Treasury. The bizarre thing is Italy and Spain collapse. The reason is not because there's less risk, is because when the economy is improving, the risk-free rate, so bond goes up, but the spread go down. So you have a compensating effect.
All right, but we are seeing a pickup in instability in the US.
That is true. It's an instability because you don't know what the Fed will do, you don't know when they will do it, and etc. So the increase in volatility in Treasury, for me, is normal and will continue.
Do you think it will go much higher?
No, but if you look at what has happened in terms of volatility in the Treasury market, in the bond market, in the equity market, there has very clearly been a very big dampening effect from QE. So if you remove QE, volatility should return to normal.
Rise. Yes, okay. And we may even get tapering in December.
Well, our house view is January, but yeah, December is probably not impossible. I think Q1 is the most likely.
Okay, now the question is this good news then for the economy? Will economies grow better if we have more stability in bond markets? Let's have a look at our second chart where tell us what you've plotted here.
Basically this chart tells you that you had a big sell-off in Treasury, that we know. That's the green line.
The green line, yeah.
The blue line tells you that the bond is following. So when you have an increase in rate in the US, typically Europe follows. But what is interesting is the red line. That's the average interest rate in Europe.
Right.
And it has not moved this year. So basically what's happening is the bond, so interest rate in Germany follow the US.
Okay.
But you have a decline in Italy and Spain.
But what does that mean then for economies then?
That means that if the Fed is doing tapering, the risk is you have a tightening in the US and Europe would follow the tightening. Well, it's too early, obviously.
Monetary policy tightening, squeeze on the economy, in other words.
Exactly. But
that's not happened.
But it's not happening because the spread in Italy and Spain are being reduced. So that actually is a good news for Europe to the extent that you don't have a monetary tightening too early in the recovery.
But of course the big question is then, is that going to last? Is this a sort of the calm, is it a lull before the storm?
Well, hopefully it will last because what you have is actually a tightening in Germany, which is the best country in terms of economic performance.
It needs
and a loosening, and a loosening in Italy and Spain, which are the countries that need it. The risk is at some point you have a political event or some of the risk that materialize in Italy and Spain, and then you would have a reversal of that.
Thank you very much, Stefan. So volatility has fallen a lot, especially in the Eurozone peripheral markets of Italy and Spain. Low volatility doesn't necessarily mean low risk, but for the moment, it's helping those economies.